Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now.
Hello, I'm Thane Stenner, founder of Stenner Wealth Partners of CG Wealth Management. I'm your host of the BNN Bloomberg SmartWealth podcast, where I get to interview thought leaders, business leaders each month and share their insights and knowledge with you on an ongoing basis. So I'm very pleased to have a repeat guest, Ben Rabidoux, back on as a guest for us here today on an always seemingly hot topic of real estate and also, the credit markets here in Canada. So Ben, thank you very much for making the time out of your busy schedule.
It's great to see you, Thane. Thanks for having me back.
Very welcome. So it's about a year ago that we interviewed with Ben last, and a lot of what he said has come true. So I just wanted to make sure we had him back on to give us his latest thoughts. Give you a little bit of background on Ben. Ben is the founder of North Cove Advisors, a boutique research covering Canadian housing, macroeconomic, and household credit trends. North Cove Advisors is consistently ranked in the top 5 Canadian economic research providers by Brennan Wood International, as voted on by institutional investors. So very highly regarded in the institutional research space, and put in a plug for Ben and his group here. His research is certainly well worth paying for. Ben is also leads the research team of Edge Realty Analytics, which provides similar research and advisory services to the real estate community of professionals. He's also a frequent commentator on all matters relating to housing and housing credit, having been featured in all the major media here in Canada, as well as a number of business publications internationally. So again, Ben, welcome. Again, thank you for taking the time to be on today. It seems like to me that, real estate and the credit cycle are some of the hottest topics on people's minds. And I think you're getting even more so today. Interestingly, we interviewed you last November. We're about almost 24 podcasts in since we launched SmartWealth. And your podcast was actually the number 1 watched podcast out of our guests today. So again, good job then, and hopefully we get a great response on today's session.
Canadians love real estate, right?
Yeah, they do. They do. So, why don't we just start off with a big picture question? I mean, there's very few people in this country that have the pulse of the Canadian real estate market, boots on the ground, research on the ground, as much as you do, I think, today. And you're highly respected because of that. What are you seeing out there today? Like what are some of the big picture things that you're seeing, especially based upon the fact the last 22 months, interest rates have gone up by about 5%. So your thoughts?
Sure. It's probably helpful to back up a little bit and kind of walk through how 2023 evolved. One of the things that we typically see in Canada anytime we have kind of a housing mini downturn, and we've seen them 2009, 2012, 2015, 2017, 2020, typically brought on by some sort of regulatory involvement where we're tightening lending guidelines or we're tightening on foreign buying. And what we find is we tend to have shallow, short downturns in Canada, right? Where prices fall 5-10%, and then within a year they've recovered. And normally what you see is the first thing that happens is listings evaporate. So sellers, by and large, will, if they don't have to sell into a weak market in Canada, we've been conditioned not to. And the expectation is if you can hold out for a year, then typically you can get your price, right? And you can kind of recoup those record prices. And the reason I mention that is because towards the end of 2022, we saw that dynamic playing out where sales had been weak, but new listings started to really fall. And we started to see consistently 20 to 30 year lows in new listings month after month, right into early 2023. And the reason that that's important is because it really helped keep a lid on overall inventory in the major metros across the country, such that when we hit early 2023 and that kind of key spring buying season, we had a bit of a pullback in rates. So mortgages pulled back to the mid 4% range. And there was just not a lot of supply. And so it pulled back enough. And you may recall at that time, there was a widespread expectation that the Bank of Canada was done. And so there was a bit of confidence return to the market. There were some people who I believe were well-qualified buyers that just didn't want to kind of catch a falling knife. And you got to remember, young home buyers today were hearing, they go back to early 2023, they were hearing all these horror stories from their parents, like, hey, my first mortgage was 10 or 12 or 15% or whatever it was. And they're sitting there going like, well, I don't want a 15% mortgage. I'm just going to wait until I have some clarity. And then in the spring, you had the Bank of Canada signal that they're done. You saw some demand come back into a very supply constrained market. And we saw prices rise 5 to 10% off the lows over the summer, right? So after pulling back 10 to 20%, depending on the metro, they then effectively recouped half of those losses through the summer. And then we had the back-to-back rate hikes over the summer from the Bank of Canada. And I really think that kind of shattered the psychology of prospective buyers. And I think that we sort of had a moment where people began to recognize that perhaps this whole higher for longer mantra, that there was something to that. And the reason that's important is then you fast forward to the last few months. We have now seen sales really roll back over. We're now kind of plumbing the lows that we saw in mid-2022. But more importantly, that's also coming with a significant increase in new listings over the last few months. And that's something that we really have not seen before in a downturn. And I think what it speaks to is I believe there was sort of a widespread expectation that if you could just sort of tread water for those 6 or 12 months, we would get back to a new high in housing. And so, for example, if you were a cash flow negative investor, you just had to skate 6 or 12 months, the Bank of Canada would slash rates and you would be fine. Your cash flows would kind of stabilize. And I just think that people are starting to recognize that maybe it's not going to be that simple. Maybe we're going to have to deal with higher rates for longer, and stomaching that sort of negative carry is getting too punitive, and you're starting to see supply coming into a weak market. And consequently, you're seeing a pretty substantial build in inventory. Now, we're still not at alarming levels in terms of active inventory. If you look in across the country, we're still only back to kind of pre-COVID norms. A little higher in Ontario, less so in Alberta. Alberta's still sitting near 20-year lows in inventory, for example. So very geographically diverse when you look across the country. But the way I would characterize it from a high level is things look very weak in Ontario. We're seeing prices roll back over again in the last few months, in particular the big metros in Southern Ontario. They look quite soft in the mainland BC. They still look very good in Alberta, very good in the Maritimes, and a little squishy in Quebec. So it's really a mixed bag, but really the headline weakness that you're seeing when you're seeing sales down 5.6% month over month, which we just learned today, when you're seeing prices down another percent, seasonally adjusted, all of that's really coming out of Ontario right now. And that's really where the pain is being felt the most.
So maybe let's turn to what would you, I basically want to put on the table kind of the bull case from here and the bear case from here, from a real estate point of view. So let's start off with the bull case. What if you had to make a bullish case for real estate, or for the investor, for the person that's looking to buy today? What would you tell them for the bull case?
Well, I think it's very simple. It's, if you believe that Canada can sustain anywhere close to this level of population growth, we're just not going to have enough housing, right? It's very simple. And concurrent with that, I would also point out that high interest rates don't just curtail demand, they also curtail supply, right? And you're starting to see developers pull a lot of projects. You're starting to see, particularly single family building permits are starting to look very soft. And so you roll those trends forward. If we continue to see record population growth and a slowdown in new supply, you could certainly make the argument that what we're setting up for is a period of time where affordability is going to drive the bus, whether that's the next year, 2 years, whatever that looks like. But coming out of that, when demand eventually normalizes, and it will normalize, it's going to normalize into an extremely supply constrained market that could result in a dramatic snapback in pricing. And I think that's a very plausible scenario. Like, that's something we have to have on the table. Now, there's a separate discussion that we should have related to that, and which I think I articulated in our last podcast, which is just that population growth in Canada is clearly overstated right now as a function of some highly pro-cyclical dynamics. But maybe let's put a pin in that for now and come back, because I'm not a believer that a year from now we're going to have population growth of 1.2 million, which is what we've had in the past year. I think I would go so far as to say that's virtually impossible. But I can lay that out for you. That's
Okay.
the bull case. Okay, so put a pin in that. Let's get back to the bear case. I think the bear case is very simple, which is just that interest rates don't have to go any higher from here. If they stay at these levels for any length of time, it's going to really hurt, right? They are sufficiently high to cause very significant damage to the economy. And so if you're of the view that we are in a structurally higher inflation regime and a structurally higher interest rate regime, that's very bearish for housing. And so I think, by the way, I think both of those scenarios are somewhat complementary. You could make the argument that over the next 2 to 3 years, yeah, the rates and affordability story are going to drive the bus. But beyond that, it's going to be the long-term underlying fundamentals like supply and demand. And so it's not a crazy scenario to think that we're going to have a period of time where housing is quite weak and then a very sudden snapback on the other side of this when demand eventually normalizes.
Gotcha. So let's talk about the investor population, the people that are buying second, third homes, et cetera, or that have recently. Do you view them, first quick, simple question, do you view them as investors or speculators?
By and large, I'd say speculators. I don't think they see themselves that way. I think they sort of view it as a forced savings, and ultimately rents are going to appreciate and they'll sort of become cash flow neutral. But I've got this great index where we just track, okay, if you bought a condo in Toronto every month and you financed it at 80% loan to value, right, at prevailing house prices, prevailing rents, what does your cash flow look like? And I mean, it's turned so deeply negative in the last year and a half. But what was interesting is, it's been negative really since kind of 2016. And that's assuming you financed at 80% loan to value. So you put a 20% down payment down. But what people forget is when interest rates were very low, you had a lot of principal repayment kind of front loaded, right? So when we were back in the days of like the 2% mortgage rates, you had like 2/3 of your payments from day one were principal. So if you added that back to the monthly cash flows, you could actually make the argument that, like, yeah, I'm out of pocket, $100 a month on the rent, but I'm paying off $800 or $900 in principal. Okay. And so, like, I don't love that argument, but I kind of understood it.
Mm-hmm.
Now you fast forward to today, even when you add back principal repayment, you're deeply negative, like $1,500 a month. Like, it's just I don't know how those numbers work. And so I would characterize that as some sort of like soft speculation.
So let's just walk through the order of things as to where you could foresee things going here the next 12 months from a point of view of, there is definitely some softening taking place in the GDP numbers and everything else. So just what are the indicators that you're looking at, and what do you think the domino effect will be?
So a lot of this is going to depend on rates and on consumer confidence. And frankly, on whether the Bank of Canada can engineer somewhat of a soft landing without really blowing apart the labor market. And that remains to be seen where they can pull that off. Assuming that what we're seeing today is the status quo. So let's assume that rates hold here for any length of time. You have to remember that there's sort of an order of operations here. No one just wakes up one day and is like, that's it, I'm not paying my mortgage, right? There's a natural order of operations. So what you tend to see ahead of kind of any sort of credit stress is you'll see things like credit card debt will start to rise. Okay, people will begin to utilize more of their credit availability. Then you'll start to see a slowdown in discretionary spending. So in other words, people start to tighten their belts. All of a sudden, it's they're spending less on hobbies. They're buying the non-essentials are kind of going out the window. Okay, now we've seen those two things, and I would point to, for example, the Canadian Tire quarter, just this past quarter, where they really commented on the degree to which they've seen a pullback in discretionary spending. And that's not the only retailer. You're kind of hearing that across the board. You look at the credit card data, right? We're seeing payment rates falling. right? We're seeing charge-offs rising, delinquencies rising, the things you would tend to expect to see. Now, what we have not seen yet are any job losses. So typically, I think the last thing that's needed to kind of push the consumer over the edge and see any material uptick in delinquencies is you need to see some softening in the labor market. And I think we're starting to see the early signs of that. And so I would expect by the end of the year, and especially early into 2024, you'll start to see a material increase in non-performing loans. And let's remember that as of today, we're still only at 15 basis points for mortgage arrears nationally. I mean, that is effectively at an all-time low, and compared to a long-term average of about 35 basis points. So when I say that insolvencies are probably, or I'm sorry, not insolvencies, but mortgage delinquencies are going to double or triple over the next year, I think that sounds like an extreme prediction, but you have to more than double just to get back to the long-term norm. And I think that given where rates are currently and given how levered the household sector is, that seems like a really likely outcome at this point. Now, a related discussion is why hasn't it happened yet, right? And this is the one thing I think you were being a bit generous in describing my predictions in the earlier podcast as largely having come to pass. I think I was early, and I think I underestimated how slowly this would progress. And there are reasons for that, again, if you want to chase that rabbit, I'm happy to.
Yeah, I mean, it feels like a slow motion train wreck in some ways to me, everything that I'm seeing. But again, maybe let's just back up a little bit further. So explain to the audience how you get your data, how you get your research, and the frequency of which you're pulling it. Because I basically want to demonstrate here that you really are looking for markers and getting what I would call live information. Whereas a lot of times in research shops, the research is a bit dated, 3 months old, 6 months old, and it's not really in line with what's actually going on right now. So just for the audience, maybe explain kind of how your research group does that.
Yeah, absolutely. I appreciate that, because that is kind of, I guess you'd call it our value add, is have a really deep understanding of kind of the major macro trends that follow all the major economic indicators really closely, housing indicators, and then mesh that with a lot of kind of company reports, what companies specifically are seeing. But then more importantly, and I think where we get into kind of the value add for my clients, is that spend a lot of time just talking to practitioners, right? My view is if you sit down with a realtor in Toronto, or a mortgage broker, or an insolvency trustee, or a real estate lawyer, or a developer, what they tell you will be the Bloomberg headline 6 to 8 weeks down the road. Like they're that far ahead of the data. And so, a lot of research shops will just lean on that data, but I think they're really missing the real value is in talking to the practitioners who are out there every day. And so what I do for my clients is, we'll often host kind of days in Toronto where we'll just pull together a bunch of industry types. We'll just sit down over a dinner and we'll just kind of get a sense of what's really going on. And I do that regularly. And it's consistently striking, first off, how far ahead of the headlines they are if you just take the time to go talk to them, right? But also the things that are really insightful in terms of just like things that are open secrets in the industry, right? Like things that everybody understands, right? Whether it's, mortgage document fraud being much more pervasive than anyone wants to understand, or whether it's certain lenders that are much more aggressive on certain products than others. I mean, these are out there. If you just pull on a few threads, you get a very different view of what's happening in the Canadian housing landscape than just reading a research report.
Yeah, very well said. We'll take a quick break and we'll be right back.
Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now.
Thanks for sticking with us. We're back with Ben Rabidoux. So let's pivot to another topic that I'm hearing more chatter about, and that is OSFI and CRA, and the various groups are kind of getting together about potentially linking underwriting directly to the CRA tax numbers for each person that's being underwritten to avoid potential fraud.
Yep.
So maybe just comment about that, Ben.
Well, I think it's coming. We know from some of the parliamentary. So I testified for the Standing Committee on Finance on this topic. I know Ron Butler, who's a well-known mortgage professional, has a big social media following. I know he spoke to the same committee that I did, as well as Mortgage Professionals Canada, which is the industry group that represents the mortgage industry. And all of us had the same recommendation, which is just have direct linkage between the tax authorities and the lenders to verify stated income, or at least the income documents that are submitted on a file.
Gotcha.
They've had this in the US for 20 years. I'll just tell you for the listeners, mortgage document fraud is a much bigger issue than we care to admit in this country. And I would point them to the CBC Undercover documentary from last year. It was November 2022. Just look that up on Undercover on mortgage document fraud. It's striking. It's striking only to those who aren't in the industry and aren't doing what I do, which is go out and talk to people. Because this was, again, this was one of those things that was well understood. Now, I'll just tell you, this is coming. When it comes, I believe it will represent a very substantial de facto credit tightening. Because I think, if we're able to align affordability with underlying income, it's going to be a serious headwind to demand, especially in certain pockets.
Yeah. So, lots of research come out even from Canaccord Genuity and various bank analysts around how the next 3 years from 2024 to 2026, there's something like 63% of all mortgages coming due in this country. So how do you think that's going to play out?
Well, it's not good if rates are going to be where they are. You can kind of, if you look at it, mortgage originations, there was a huge spike in 2020 through to early 2022.
Yep.
And with the heaviest in 2021. And that coincided with the time where we were giving variable rate mortgages at, in some cases, sub 1%.
Yeah.
But as a general, we'll call it 1.2%. So 1.2% mortgage. Now, you kind of follow, that's like the pig going through the proverbial python, and you kind of roll that forward and you kind of estimate, based on the terms at origination, you can kind of model out what these are going to look like. And we're going to see very large renewal years, especially in 25 and 26. And so what it's going to look like is really going to be a function of where rates are at that time. There will almost certainly be a substantial increase in payments, particularly for the borrowers that have the static payment variable, where they locked in at 1%, but the payments have not risen to reflect rising rates. Those mortgages contractually have to reset at the original amortization rate. So they kind of get squeezed on two fronts, right? The rates jump, the amortization shortens, and you're looking in that case at payment shocks 40 to 60% on the monthly payment. That's the most severe, and the biggest hit from that'll be kind of that 26 vintage. But there's really nowhere to hide, right? As these mortgages roll, they will be renewing at substantially higher rates. Now, what's interesting is if you look at a chart of household debt service ratio, which is the share of income that goes to principal and interest payments, it's the data series that correlates most cleanly with non-performing loans at Canadian banks on the consumer side. And it makes sense. As rates go up, households have a harder time servicing those payments. So there's no rocket science. You don't have to overthink it. Okay. You look at where we are today, we're not far off of an all-time high already for debt service ratios. And that's before we've seen this surge in renewals. And importantly, that's with those static payment variables not seeing any meaningful increase in payments yet.
Gotcha.
So as that rolls out, by this time next year, we'll be at a record high for debt service ratio, an unprecedented high by a substantial margin. And then it only gets worse from there. And there's just no way that does not get vented through much weaker discretionary spending and rising non-performing loans at the big banks.
So the Bank of Canada's got to know this, and the banks know this. So, they're setting aside more provisions each quarter, kind of anticipating this coming up. And like you said earlier, it really comes back to what interest rates are likely going to be doing over the course of the next 12 to 36 months. So if you were a buyer today and you were financing, what would you be inclined to do personally based on all the data you see? Would you be inclined to do a 5-year mortgage, do a 3-year mortgage, or go with variable with the hopes that interest rates have peaked and actually were likely to come down?
Yeah. So I would.
So it's a crack crystal ball question. I get it, but
no, it's a fair question. I get it a lot. First off, I would refer people to a mortgage professional. So this is not advice, but if you're asking me what I personally would do, well, I think it really depends on how risk tolerant you are. If you have the wiggle room in your budget, I would think, like, I'm in the camp that thinks the Bank of Canada probably has peaked. The variable could look compelling if you get enough of a discount. Right now, the variable rate discount off the prime is only 60, 70 basis points. It's not a ton. If you see that widen, I think it could make a lot of sense to go variable if you have the flexibility in your budget to if I'm wrong, right? You want to be able to absorb
it. Yeah.
Otherwise, I think the sweet spot's probably kind of that middle kind of 2-3 year fixed rate, because it's kind of, there's no great option. So it's kind of the best blend between reasonably low rates, relatively all your options, but also the flexibility to lock in at a lower rate and not have as steep a payment or a breakage fee as if you were to go 5-year fixed.
So here's another crack crystal ball question. Personal views. How much more downside from here, if that's in the bear case, could the real estate market look like over the next 12 to 36 months?
Oh man.
Had to ask you, Ben.
Yeah, there's no way. It's funny, as soon as you put a number on it, like you're going to be wrong and everyone's going to dunk on you either way. I think the direction is clearly down, right? Especially if rates stay at this level. But again, really depends on where you're talking, right? Am I worried about Alberta? Like, you got 20-year lows in resale inventory, you got demand that still looks good, you've got affordability there today, even with rates where they are, that's better than it was in 06, 07. Like, it's hard to be really worried about that. Same thing in Atlantic Canada. Like, how much downside is there, right? Calgary, like, prices have gone nowhere in a decade outside of the last 9 months. Like, is that a bubble? Like, no. So I'm not really worried about that. But could the Southern Ontario Metro see another 20 or more % come off over the next? Yeah, absolutely. They could, if rates stay where they are. Like, the math just doesn't pencil, right? So it's hard to say. It's really ultimately going to be a function of where rates are, but there's a lot of downside in the big metros, unfortunately. But again, like, eventually the things will normalize, and I'm equally worried about the supply picture coming out of this.
Well, so let's talk a little bit more about that. So you mentioned earlier that last few months, basically, supply has been picking up, I believe is what you said.
In the resale market. So I want to make the distinction.
Gotcha,
when I say I'm worried about supply, I mean developers bringing new supply.
Gotcha.
In terms of homes that are being listed for sale, resale inventory, that's definitely trending up.
Gotcha. So with that in mind, I think in the last week or so, it's been some national news coverage on a bunch of fires taking place in some conspicuous locations in Ontario. Any comments about that?
Oh man, Thane. Yeah, they're suspicious. Like, I don't know what else to say. Look, you see fires in good times, but you can't help but notice there seems to be a lot of them. But I don't want to. Yeah. I don't need any legal letters.
No, understood. Yeah, just fair enough. So Alberta, you're kind of at least neutral on, maybe even positive about. What about in our neck of the woods in Vancouver, Lower Mainland? What are you hearing there?
Well, I think you've got some unique challenges. There's certainly an element of supply constraint in the single family market. You can see that. But you have tremendous affordability challenges. None of that is new, but it's certainly been taken to the next level. You're seeing affordability that, kind of the worst it's been in 30 years. You have the added kind of complication of just, we don't really know what foreign capital flows are going to look like. And you're starting to get the sense that they're getting the world is not as open, unfortunately, as it was even a couple of years ago in terms of cross-border flows and tensions with China. And you do wonder how those manifest now that the West has taken a more hostile stance towards, just as a random example, right? The U.S. Treasury, or freezing Russian central bank assets. It's just a signal that the West, maybe the rule of law that other countries sought, in terms of protecting their capital here. Maybe it's not what they thought it was. And you do get the sense that that flow of capital is not what it was a few years ago. And so it remains to be seen how that all plays out. But as of right now, it's certainly not faring as badly as Toronto. The inventory numbers are only back to kind of what you might call normal levels. So there's not a ton of homes for sale. Sales are soft, but they're certainly not as weak as they are in Toronto. So, at this point, I think prices are going to grind slowly lower in Vancouver through the winter, and then we'll see what happens next spring. But I'm not as concerned about Vancouver as I am about Southern Ontario, but it is certainly soft, and the prices are coming down there for sure, and they likely will continue to.
So what's the toughest question somebody could ask you right now in regards to your field of expertise? It's the toughest question. You kind of go, okay, I really don't want to answer that question, but what would the question be?
Well, I mean, anything where you're asked to put a specific number on something, it's that's just not how things work. But I will tell you what I get a lot of, and that I find really challenging, is people will be like, well, should I buy? It's now a good, I get that all the time. Is now a good time to buy? It's, well, who are we talking about here? Right. I mean, if you're a young family with kids and you don't want to, you're willing to have some stability and ownership and have your kids in one school and not have to worry about getting, like, maybe it's worth it to you buying today and having to stretch, and maybe you lose a bit of equity over the next little while. Like, that's a very different discussion than somebody who's, single and barely making ends meet in the rental market. And like, do you know what I mean? Has to stretch really far to get in the, do you know what I mean? Like those personal finance questions are so challenging. I dodge those as best I can.
I can see why. Well, and actually I relate, you get asked all the time, what would you invest in today? And it's really a function of kind of where the person's coming from in their current financial situation. So I totally get how you have to qualify that, Ben. So again, looking out, when do you think things, if you had to guess, it's a guess, do you think this is going to be kind of a prolonged grind on the real estate and credit side over the next 2-3 years? Or do you think it could be more like a V, right? You could end up getting a drop in rates and things kind of light back up quickly.
So again, there's a continuum of possible outcomes here. I'll tell you what I think is likely. I think unfortunately rates are going to stay higher than even our own central bank would want, or would normally sort of allow. And the reason for that, one of the things people have to realize is, so going back to that concept of the debt service ratio for households, which I think is one of the most important macroeconomic indicators out there. Right now, Canada is just bumping up against all-time highs. Okay, the U.S. is near all-time lows. So we have this record gap between household debt service ratios between our two countries. Now, the reason for that is after the financial crisis, you had a lot of deleveraging in the U.S., but also importantly, they termed out their mortgages for 30 years, right? Yep. And so there's no impact whatsoever of rising rates really in the U.S. yet. Now, the concern then is, I just don't see a scenario where the U.S. economy slows more than Canada does. Do you know what I mean? Given how tied we are to housing, how tied we are to interest rate sensitive elements of our economy. And if that's the case, you can make an argument that if the U.S. stays as hot as it is, and if the Fed has to keep rates higher for longer stateside, Canada could get dragged into a situation where our rates stay higher and trade in sympathy, especially longer on the curve. Because of how high rates are in the US, even as our own domestic economy starts to wilt. And I think that's always kind of been like a hypothetical that's been out there for the last 5 or 6 years. I've been flagging that as a risk. And now I don't think it's as much of a hypothetical. I think it's if anything, it's likely. And so that's going to hold rates higher than they otherwise would be. And so I think you are into this kind of, most likely it's going to be a grinding kind of multi-year downturn with just higher rates that take a while to kind of filter through. Now, the other thing that we started, again, there's a lot of moving parts here. So it's all going to depend on how bad any potential recession is, how high rates stay, all of these things. But the one that I mentioned earlier, and I said we'd put a pin in, but I think it's worth revisiting because it's one of the major dynamics that people underappreciate. And that's this idea of population growth. And there's a consensus right now that what we're seeing today in population growth is somehow a new normal. Okay. And so to frame it for your listeners, we had 1.2 million people added to the Canadian population in the past year. So that's about a 3.1% growth rate. It's unlike anything we've seen.
Yep.
Now, most people would know that the feds target about 500,000 permanent residents in a year. So then the question is, well, if they're targeting 500,000, how did we get to 1.2 million? Okay. That's a really important question. And the answer is, we've added, in addition to that 500,000 permanent residents, we added 700,000 non-permanent residents. And these are international students and work permit holders. Okay. And it's important to remember that that cohort is highly volatile. And in every recession that we've ever seen in Canada, any recession of substance, right? So I'm not counting that 2015 blip, but any meaningful recession, we see outflows of that cohort. It does not just that they drop to zero, they actually decline. Now, the non-permanent resident cohort today is almost 6% of the total Canadian population. We have never seen anything close to that. And so let me just frame it for you this way. If you believe that Canada is going to add another 1.2 million people next year, you have to believe that Canada will need 400,000 temporary workers. And I would argue, what are they going to be doing? We are seeing job vacancies plummet right now. We are seeing the unemployment rate tick up by 60 basis points in the last 6 months, 70 basis points in the last 6 months, which seldom happens outside of a recession, by the way. Where's the demand for 400,000 temporary workers going to come from? So rather than adding 700,000, my contention would be that it's much more likely that we drop closer to zero over the next year. And depending on the magnitude of the recession, it could even be negative. That may take longer than a year for that to materialize, but the point is, we've never seen an economic downturn that isn't also kind of coincident with an outflow of non-permanent residents. And that's not a small dynamic, right? And so we could see population growth print much weaker than people think for a period of time. And if that's the case, all bets are off, right? Like if, we're sort of, again, we're of the view that housing is going to have this, it'll ultimately be underpinned by these strong underlying fundamentals. And there's a chance that those underlying fundamentals aren't there for at least a period of time, and it may take longer to stabilize, right? Gotcha. So there's a lot of moving parts. That's why it's hard to put a hard target. You got to think in probabilities here, but I think that's a reasonable base case, and it just grinds for a number of years.
Gotcha. And like you said earlier, I think a big part of this is rates, interest rates, and where they go, and that's
it's the big thing. There's no question. It's the big thing.
Agreed. I think, given the fact that the Canadian economy is narrower in focus than the U.S., and I think you said earlier, I think it was a really smart comment that, if they have to keep their rates higher and we have to try to maintain our rates longer, I think at the end of the day, that's probably a game of chicken. I think, the Canadian government, in my view, would likely have to kind of peel away and drop rates sooner than the US, which means our Canadian dollar is going down.
Well, that's the issue. And then that feeds back into some inflationary pressures. So you're right. There's no easy decisions here.
Correct. And then we've got a political situation coming up, right? We've got another election in 2025. And, lots is kind of on the go there, as we speak. So any other 2 or 3 tidbits you'd like to leave our listeners with?
Oh, that's a good question. I mean, it's a dynamic time. I think, I think, I don't know, in terms of just things that I'm watching right now, I think, so a couple things that people may want to watch. So first off, think about where the stress is going to show up first. So we talked about credit cards. That's one area that you're going to see it. So you can follow Credit Card Trust. They all report monthly. You get really good timely data. So I track those, watch them like a hawk.
Yep.
But also, there's 2 other areas that I'm watching for signs that we're right. One is, or signs that my thinking on how this is going to evolve is correct. One is, in particular, the loan books at Bank of Nova Scotia and National Bank, because those are the 2 banks that have the true floating payment mortgage. All the other banks have static payment variables.
Gotcha.
And so within the book at like BNS and National, you have borrowers who have gone from 2% to 6% over the course of a year and a half in their mortgage rate. If the stress is going to show up anywhere, you're going to see it there. And so I would point your listeners to early stage delinquencies. So people who are behind kind of 30 to 60 days or 60 to 90 days, they're spiking, right? So you can see the stress is there, right? That's one area. And I would say that if we skate through the next year or so without any meaningful impact at their book, then it's hard to make the case that the rest of the market's going to get hammered, right? So that's one thing to watch. The other is at the non-prime lenders. So we have a thing in Canada where our non-prime borrowers opt or are put into the shortest term mortgages. So non-prime mortgages in Canada are overwhelmingly 1 and 2 year mortgages. And so I would point people to the likes of, just to put some names out there, Equitable Bank, Home Trust. If you're renewing a 2-year mortgage today, so if you took out a mortgage with, I'll use Equitable as an example. Sure. 2 years ago, 3.5%. Today you're renewing at 7.5%. Like that's a 2-year change in rates, 3.5 to 7.5. I can't envision a scenario where that is not highly disruptive for a significant portion of their borrowers. And so, we need to be watching that just for any signs of stress. Now, it's not there yet, right? And so my point would be, if those exposures are fine over the next year, it's really hard to make the case that the Royals and the BMOs or whatever are going to have big problems when those loans start to renew in 25, 26. Do you know what I mean? We're kind of getting an early kind of a stress test of how this is going to play out. And so that's what I'm watching. And we'll see, but we'll know whether or not we need to worry about the broader, some of the other names, just based on what's happening there over the next little while.
Yeah. So early indicators, and again, it's one of the reasons why, investors and institutional investors kind of rely upon folks like you to kind of relay, as early information indicators as possible. So just on that, Ben, maybe comment about your website, kind of how you work from point of view of research. It's not meant to be an infomercial, but I'm kind of giving you an opportunity to put in a little brief plug on North Cove.
Well, I appreciate that. I don't really do much with the website. I actually don't even advertise or market. Everything is word of mouth. So if there's institutional investors who are listening that may want just coverage and people who are kind of sniffing out any kind of idiosyncratic potential credit issues, that's kind of my bailiwick. And you can reach out, ben@northcove.net, or shoot an inquiry through the site. Folks who are involved in the real estate industry, if you have a verifiable professional email address and not a Gmail or whatever, but you can go over to edgeanalytics.ca, you can sign up, you get a month for free. You can see what I'm doing there. It's the same stuff I'm putting out to my institutional clients, but with slightly more accessible language and just something that's a little more usable for folks in the real estate space to help them think about as this evolves. So those are the two ways you can get a hold of me.
Excellent. And we deal with a lot of Canadian family offices as well, so they're institutional looking for good research too. So it's very good. So thank you, Ben, for taking the time for providing your current thoughts on things. And I look forward to kind of actually having you again. Maybe not a year out, but we'll see. We'll see if this becomes a regular cadence. But thank you once again. Very insightful, and have a great rest of the day.
Thanks, Thane. You too. Thanks for having me.
All right. Well, thanks everybody for listening. This is Thane Stenner. My next guest is Tony Dwyer, CG, coming to us from the New York area. He'll be commenting about the markets. Really looking forward to that one next month. Our website is www.stennerwealthpartners.com. Take a look, and you'll see more information in our podcasts listed there. Thanks, everybody, and see you next time.
The comments and opinions expressed in this podcast are the results of work done by Stenner Wealth Partners. They may differ from the opinion of Canaccord Genuity Corp. and should not be considered as representative of Canaccord's beliefs, opinions, or recommendations. All views expressed in this podcast are provided for informational purposes only and do not constitute an offer or solicitation to buy or sell any securities. The statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views are intended for general circulation only and do not have any regard to the specific investment objectives, financial situation, or general needs of any particular person, organization, or institution. Canaccord is a member of the CIPF. The comments expressed in this podcast are the results of work done by Stenner Wealth Partners. They may differ from the opinion of Canaccord Genuity Corp. And should not be considered as representative of Canaccord's beliefs, opinions, or recommendations. All views expressed in this podcast are provided for informational purposes only and do not constitute an offer or solicitation to buy or sell any securities. The statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views are intended for general circulation only and do not have any regard to the specific investment objectives, financial situation, or general needs of any particular person, organization, or institution. Canaccord is a member of the CIPF.